I personally have made this mistake myself in my career in the past, or as an investor in the past, and I'll share it because I think one of the most phenomenal things we can bring to clients is all the mistakes that we've made personally. And more importantly, or as importantly, we've seen people make mistakes too. Sometimes we're not able to psychologically and behaviorally coach somebody into the right decision making. So we see them make a mistake and we're like, it sucks. But they make the mistake and we get to see that present itself. One of the things I've done is I've chased a high yielding investment. In my situation, it was a closed end fund. So it's operated like a mutual fund or an ETF, kind of a hybrid of those two. And it had a very attractive 10% yield. What I didn't do at that time, this was early on in my younger investing days, was I didn't really unpack what was creating that yield. Where is it coming from? Well, it turns out in my scenario that it was about a 9 or 10% yield, which at that time was really, really attractive, like now. And most of that yield, there was only a couple percent actually coming from true returns of the underlying portfolio. It was all return of your own capital. It was like a legal Ponzi scheme where you invested and they promised you a certain yield. In this case, they didn't promise you a rate of return if you read the prospectus. They promised you a yield, and that yield was just getting your own money back. So
sounds like an annuity.
It was bad. Yeah, kind of like an annuity in that regard. But not only did you got your own money back and you thought you were doing great because you got the yield, but yet the price of that just kept going down because they were returning capital. They were returning your own money. So the price went down. I had a great yield, but yet if my average annual return was a negative 8% and I had a 9% yield, then I returned 1% a year, which wasn't good. That is and can be the real issue when we go chase yield. One of the things that I think really comes into play here is deciding what is the total return of the investment? What part of that is coming from cash flow? And is that cash flow sustainable? Alex, I think we've even seen this present itself in real estate, where investing in real estate can be really tricky, right? Because you can go look at something and there's leverage, right? You buy a $10 million property, but it's leveraged by $8 million or $9 million of its leverage. And so you're getting a return, but the return may not even be enough to actually cover the cost of all the operating costs and the expenses and the cost of the leverage. So even though you think you're getting a nice yield, it's a negative real return or negative total return.
Yeah. It's unfortunate too, because I think, this goes back to why we even do this show and why you even wrote the book, however many years ago it was, not 10 years ago?
Too long. 8 years ago.
8 years ago is because there's so much information out there available to people. And most of it is, it's almost all self-serving, because if somebody's building a product, they want to sell the product. If somebody's selling you a real estate investment, they're going to show you the part that's the most interesting to you, the most attractive to you. And maybe without lying or omitting information, they just won't maybe make that font size as big as the other font size, right? It'll just be in like page 912 of the PPM or whatever. That's a problem with some of this stuff, is it can get very complicated very fast. Bonds shouldn't be so complicated. Like back to like the initial, I was attacking bonds. It's a boring roller coaster ride for me. Why do it if it's boring? I want the risk. I want the volatility because in exchange for that, I want the higher reward, expected reward long term. But if you do have something that's yielding something, let's go back to bonds for just a minute. It should be relatively simple, right? I'm going to lend you money. You're in exchange. You're going to pay me an interest rate, the yield in this case. Then you're going to give me back my money. Hopefully, none of that's guaranteed, but it's likely that you're going to give me back my money. But then the higher the yield, the higher the risk, right?
I think you have to associate higher yield with something's going on here, right? Somebody told me the other day, I buy this, and they ended up talking about, I unpacked it. It was a BDC. So it's a business development corporation. It's very high. Favorite. It was very high risk. Some of those are good, but some of them are very junky and crappy. And they said it's a guaranteed. No, it's guaranteed. And I'm like, what do you mean guaranteed? Like a guaranteed 11% yield, something's wrong, right? Because if the risk-free rate of return we can generally all agree upon would be like a 1-year treasury. The United States government fully backs and guarantees its yield, and that if you buy a 1-year treasury bond, they will give you your principal back after paying you interest for 1 year. That's a risk-free rate. And if that risk-free rate is in the high 3s and you're getting an 11% yield, why? It's not because it's risk-free.
The small print.
It's all in the small print. So, and you need to understand that. I think that's what we're getting at. And I think the headline here is there is a gigantic myth that because it's high yield, it's a great return. It's good. High yield is good. I'm going to go chase high yield.